You're watching What a Week here on the Nielsen Network. We've got David Shapiro, Aspen Securities, Mia Kruger, Kruger International. We're looking at the week in hindsight, and we have to kick off, David, with the tweet you put out on comparative returns for those invested in the JSE.
Yeah, you know, when I did that, I thought we'd had such a good run. And what I wanted to do is to try and see where we were in relation to global markets over a 5-year view. And of course, you have to put it into dollars so that you can get a comparison, a proper comparison. And we're still lagging. Of course, if you were in the Nasdaq, you did very well. The S&P, also in MSCI emerging markets. But the JSE over 5 years, round about 40%, it's better than we have been, but still lagging other markets. But I do have to point out one thing. If you were in the resource index, if you were in the resource 10, you would have been up round about 160%, which is just below the Nasdaq, but above the S&P. So it just shows you over the last 5 years how strong mining shares, have been. So it would be a combination of gold, platinum, and the mining houses and that. But as a broader market, we've still got a lot of makeup to do.
Mia, let's get you to weigh in. I'm sure you saw the graph.
I did. And there's an interesting thing. I was actually just trying to open some graphs here of mine, but it basically comes down to a very interesting thing that we've been seeing for quite some time now, is when you look at the numbers over various terms, you consider, when I look at all the asset classes within South Africa and then offshore exposure compared to the JSE and all of that on one graph, and I look at the Rand, then you see a very strange phenomena where you have the Rand strengthening over the last 5 years. But over the past 3 years, the Rand has weakened in the same trend as it has over 10 years. So the 5-year numbers do come in slightly different than what we see on the 3-year, 7-year, 10-year numbers because of that strengthening that we've had in the Rand. I'll try and open it as we speak, and then I might give you some insight on that.
So just to mention, Lindsay not joining us today. He will be back again next week. David, give me a sense of how this week has occurred from a news flow perspective through your eyes.
The last week and the week to come, it's been inflation. And when I say inflation has been the story. I don't necessarily understand the full implications of what's happening, but I think the big story is that we've seen the 10-year bond in the US go from below 1% now to almost 1.3, which is the highest in a year, and the 30-year bond there also peak and go over 2% as well. So that's got people investors very nervous, worried that rates are going to go up. And of course, what the drivers have been, this is not real inflation. In other words, the inflation readings are not there yet, which is what Jay Powell said. He said, show me the evidence. In other words, I want to see it. This is perception. But what definitely is happening is that we've seen big gains in commodity shares, which will eventually feed into some form of inflation, and also some very good news in the US on the economic front, which is also starting to stir worries about inflation against the kind of stimulus packages that we're getting. So it's all perception at the moment, but I mean, perceptions can shake markets.
Mia, have you had your Nespresso this morning?
I'm having it as I do. So I agree with David. The influence of the inflation coming through, even though it's just a slight increase in inflation in the developed world, is from such a low base that it does have a material effect on the valuations. And also the fact that it's literally the end of a 40-year bull market in bonds there. So that definitely has a couple of things that it could lead to. One being that a trend that we've seen, that people are seeing more and more inflows into emerging market bonds, more focus and more talk about it in the developed world than has been the case for quite some time. And I listened to an interesting a conversation this morning where they were talking about the fact that the fact that the bonds were at a zero rate, but the rates were staying low and was not increasing, made it a good hedge because it had a risk-free effect. But now the fact that the rates start rising, it has the exact opposite effect, and it actually is it's value destructive. So that actually brings the whole other argument into the picture of talking about your stock selection and whether you are now going to focus more, and this is more in the developed world than in South Africa really, on dividend paying shares, or are you still going to keep your portfolio tilted towards the tech side? Another interesting piece of research that I read during the week was from the S&P Dow Jones, and it actually pointed out a very interesting discrepancy. I mean, we've been talking about this for quite some time, the fact that value has underperformed growth. But what it showed was when you consider from the S&P 500 and you look at the value index and the growth index, there's actually only 4 shares that make up quite a substantial part of the growth index. And when you look at the top 10 shares in both of those indices, 40% of the whole growth index is actually only made up out of 10 shares. That is the highest value that has ever been. And the discrepancy between the value top 10 and the growth top 10 is massive now. So if any of those 10 shares, and really actually only 4 or 5, disappoint a little this year or just perform and underperform the market, then we do have a case of a tilt towards more value-based and less growth.
So what do we need to do given the context in South Africa right now? We have the budget next week. I see many tips being given to our Minister of Finance across the board. David?
What do we do in South Africa?
Yes, what do we do in South Africa?
I would stay with commodities. I think we're, I was talking about inflation, but I mean, if you dig deep and you take a few steps back, what is it really saying to you? And the message coming across is that we're going into a growth period. In other words, it's demand driven. It doesn't matter where it's coming from, that it's demand that is pushing up those commodity prices, even if it is demand for some of those metals that are going to be used in battery or power. So I find that fascinating. And it's not only the ones that we follow. If you go into timber, and if you go into wheat, and you go into some of the soft commodities.
It's those soft commodities that Nick mentioned in our show last week.
Exactly. So those are the ones to do.
All right. So basically.
Okay, I thought it was my connection.
Upweight your portfolios into the commodity space.
So the message is, look at the commodity market. It's pointing to something bigger. This is not just that response from very low levels that we saw. Even in oil markets, I know that there has been the freeze in Texas, which has caused some aberrations and some movement within oil in the United States. But still, even if you take that away, there is growing demand. And that's why if the inflation is going up because of growth, it's not too bad. Equity markets can actually, or growth markets can actually digest it. It's at the point where it gets to, where inflation gets to the 3s and 4s and interest rates have to go up. That's when we worry about, but I think it's some time away. So what I'm trying to get at is that, hold on a sec, this is not too bad. This is actually being driven by a change, by growth, by the resumption of growth, which we're seeing.
So I need to just explore that a little bit further. And Mia, I'm going to come to you. So are we saying that this is not a bubble? This is genuine. This is not,
I'm not, maybe Bitcoin could be a bubble, but I'm not going to go there, because it's just one person buying after another. But when you look at the copper price or the iron ore price or some of the other metal prices below that, that's genuine buying that's taking place, even if it does come from China, and even if China's buying, even if China's building roads to nowhere, there is demand in the system. You see it in the shipping rates, etc. So I think, when you see a proper commodity market, it can go. So don't be scared of this, embrace it. And I think it's going to have good consequences for us, as we've seen in the results, and just listen to Neil Froneman. He can spend a lot of money building new projects. He's got a lot of money. So I think all of those are very positive signs. So if you want to be here, I think commodities is one of the better choices you can make.
All right, so now Mia, weigh that up with the tech story that we've been playing over and over again on the show, on What a Week, for many weeks.
So, I mean, just the basic of this whole conversation is the fact that we've been talking about the fact that the valuations on the tech stocks have been stretched. It's pricing in exorbitant growth rates for many years out. The fact is, many of those companies have delivered those growth rates, and many of them will probably still keep on delivering those growth rates. But that doesn't mean the price will keep on increasing. So one of the arguments that I've also mentioned here was the fact that we might not see a big market correction. We might see a sideways crash of the market just moving sideways with big volatility for quite some time. But the commodity-driven cycle that we're seeing now, we've seen a big run up in the commodity prices, but there is demand for it, as David said. So there's a real demand, where with the other company prices, it's a little bit of a different story that we need to consider. You need to discount the earnings, etc. But with the commodity side, it seems like there's still more upside. And when you look at the longer term stories behind many of the valuations, like for instance platinum that we discussed a week or two ago, there's a strong case for it to be made in a portfolio, because the fact is there is a real demand for it. The demand is not decreasing but increasing yearly, and the price has been lagging other precious metals quite substantially. So it's an interesting combination of factors that's really supporting the commodity prices at this stage, and it's a great story for us. Hopefully, South Africa can capitalize on it, where in the past we've not participated as well as many other emerging markets in the commodity booms. We've benefited, but not to any extent in the same level as some of the other emerging markets. I hope that we can use this one to our benefit.
And of course, Neil Froneman coming out strongly around the mining indaba, lambasting government, saying that they are not putting enough effort into profiling the resources sector in this country, to the point that Mia is actually making, that from an investment perspective, there's a sense of excitement around the stocks in this space. David?
Exactly. And Neil, there are two people here. You must listen to Peter Major and to Neil. And both of them are forthright. They understand the market, they've been in the market, they know the market, and they tell it like it is. They don't make excuses. And South Africa, for whatever reason, I don't know, but we were blessed with an incredible array of metals and minerals, which we are not using to our best advantage. Why God chose South Africa, I have no idea. But I mean, we really are truly blessed in that. And we're not taking advantage of it. You name it, we've got it. So I think there is the opportunity to do so. And I think even if you listen to Neil yesterday, he was saying, he was begging government just to ease back on regulations and to allow miners, to in fact lay out a red carpet for those who want to invest in this country. I just got to add one point to Mia's point. Sorry. What she was saying is absolutely right about the big tech companies, is that they're still going to produce big results, even if it is only those four. What you will see, though, is an easing back of the multiples of the PE ratios. So results might grow 20%, but the shares will only go up 5-10%. In other words, you start to see valuation coming through. In other words, earnings catch up with valuation. So I agree, it's not the end of tech by a long way, but you won't see it necessarily rising in line with earnings.
So I absolutely agree. We're saying the same thing. So what I mean by a sideways crash is exactly that prices don't really go anywhere from here, potentially. And I mean, when I talk about that, I'm talking about the big names that's been driving the biggest share of the performance in the market and the prices. So that's the indices, etc. And that has been the tech name. So if their share prices are volatile and move sideways, yes, maybe slightly up, but sideways, then it is a natural case of earnings catching up with them and valuations becoming more attractive. And that's, at the end of the day, if you're a long-term investor, you can look at any scenario and you can go through all the research. The big thing is don't try to jump in and out at the valuation. The valuation, if you think a company is worth holding, you buy it and you keep it. You go through the ups and the downs of the price, and that's not what drives you. But this could be a potential entry point again for people. But the other side of the case is that we've talked about in-house here, is that even clients who invest throughout, people who are still young, they add to the investments monthly, etc. Doesn't matter if they start buying tech now and keep on, or the market now and keep on buying monthly going forward. Their average will still be in their benefit, and over the long term, they'll still be happy investors. So trying to be too clever around the price is never a good idea.
Ignore the noise. We've heard it over and over and over again. David, it must be one of the key tenets of investing in
yes.
I don't know. And it's very easy to do what we're doing. It's not very difficult. It's very easy to choose good stocks. The hardest thing is to manage the expectations of clients. That's the difficult, and the aspirations of that. And but choosing good companies for the long term, and it's a word that not everybody really adheres to. But that's easy. But the in and outs and the mood changes of clients, that's what you have to be good at managing.
So David, I just want to ask you, as we come to an end of the show, do you feel underdressed today, or has that not?
I do. Yeah, you should have warned me. But I do want to say one thing, and I say this with the utmost sincerity, is that my two favorite companies that I like, amongst a number of others, are Estee Lauder and L'Oreal. And the reason, I've always followed them because of the history of Estee Lauder is wonderful. If you go and read how Estee Lauder actually drove and built a company, all the samples you get, all the freebies you get, that was her. She was one lady. I mean, she could teach a lot of people a lot of things in that. But what's fascinated me during this period, and you're both you and Mia today are prime examples of it. Just when you appear on Zoom, you can't hide behind the mask, that you have to use the face creams, the makeup, and both of you look really great and really stunning. And I'm saying it's testimony to the makeup companies and to the face care companies. And strangely enough, they've done so well because of the very reason that we're actually experiencing at the moment. So it's been wonderful looking at you.
You see how good is that?
Lindsay and like,
Oh, what a great response. We caught you off guard, and yet that was very, very well put. So, David Shapiro, thank you for joining us. Mia, thank you for rising to my challenge last night, the tweet out of the blue, asking you to dress up, showing you my dress. And
thanks for giving me the opportunity to dress up again.
I thought we haven't done this for a long time, so let's bring glamour back to the markets. And I think that's really wraps up this What a Week. David Shapiro, Sasfin Securities, Mia Kruger, Kruger International, and we'll be back same time next week. Lindsay Williams will be back in the fold.